Good morning, everyone. Welcome to One-to-One Mining Investment London. We are very happy to be back in London with over 130 companies represented at this event today over the next 2 days. All right, so this is our investment leaders panel. So joining me here this morning, we have Paul Gurney, Managing Director at Beacon Securities. We have Antony Rowe, Investment Team Leader at Resource Capital Funds. We have Kruthika Bala, Head of Energy Transition and Critical Minerals for Lean in Equity and Sustainability. And finally, we have Pim Kalisvaart, Principal at Hawke's Point Resource Finance. So just to kick it off, I'd like all of my panelists to introduce themselves. So maybe starting with Paul.
I'm Paul Gurney. I'm the managing director here for the London office of Beacon Securities. We're an independently employee-owned broker out of Canada focusing on small and mid-cap growth names with a large focus on raising equity and advising on the mining side.
Antony Rowe, investment team leader with Resource Capital Funds. RCF is probably well known to many of you, but 25 years private equity in the mining metal space. My background is more mining finance banking, and I focus on the credit strategy at RCF.
Hi, I'm Kruthika Bala from Lean in Equity and Sustainability. I'm also the Managing Director for Resources Now, which is a critical minerals and energy transition hub. I work on the intersection of geopolitics and energy transition and the role of material demand that we see in the world. And I started my career out in the industrial space, and I moved up to energy and critical minerals.
Morning, my name is Pim. I'm a principal behind Hawke's Point. We are a private capital provider, and what we seek to do is find good projects managed by great management teams that we can partner up with and help progress the business plan.
All right, sounds great. So I thought we could start with a very broad view and then kind of narrow in. So let's start with a broad view of the current global political and economic environment, the implications that all of this is having on the metals and mining industry. So where are you seeing some of the biggest impacts, and how are you managing the implications of those?
Great. As a long-term capital provider, what I truly long for is predictability. I'm not getting an awful lot of it at present, but I hope to get more clarity soon. The geopolitical forces and changes in politics that no doubt we'll talk about more, I think do introduce a challenge for investors like ourselves that, like I said, want to have some predictability. I don't necessarily need everything spelled out, but things that are a true hurdle that sometimes lasts more than one election cycle, such as permitting. I think it's very important to see stability in that, so that capital providers like ourselves can get behind projects that typically do last or have a lifetime that is longer than just a single investment cycle. So I'll pause there, and I'm sure we'll get to talk about some of these topics more.
So in the broader sense, I see interest rates, high inflationary pressures, geopolitics, ESG taking the center stage and continue to play that key role in terms of building that risks there. In terms of implications, I would sort of break that down into three. There is a shift in the capital allocation that has been happening for a while now. We've seen 2022 as a very, very interesting year in terms of the investments, and I think that there is still momentum there. There's also increased risk premiums that we see in terms of implications. And the third is there is a push for supply chain resilience. And we see several initiatives, both from academia, industry, as well as from the capital markets, sort of enabling that. Well, Antony, I wonder if you have any broader views on that one.
Well, I think generally at the moment, clearly there's a slightly heightened element of uncertainty in the markets. Clearly with the recent election in the US, that is creating some doubts, and doubts clearly, as to Pim's point, impact investment flows and confidence in investments. I think we need to also take a step back and realise that we are coming off a period of probably relatively unprecedented, not unprecedented, but for a long period of uncertainty in the markets, from COVID through to geopolitical conflicts, several wars going on in the world, and high inflation rates, which are looking to maybe be extended in longer than people were hoping. So I think I think it's an added overlay of uncertainty in an already relatively uncertain period in the markets, which I think is creating issues with the liquidity in the wider markets, and whether that's public or private. I think, however, long term, the positive fundamentals remain for our sector. We remain positive about our business. Global growth, I think, will continue. There may be some headwinds from tariffs, but I think global growth will continue. Consumption will continue as long-term development of lower middle-income countries continues. There is sustained underinvestment in the sector, which ultimately plays out in to a supply dynamic which is favourable for investment. Decarbonisation will continue. I think maybe that has taken a little bit of headwinds over the last year or two. The rollout of EVs being slower, etc. But while the pathway may have slightly changed, the timelines may have changed, the trajectory remains the same. So that is again favourable for long-term investors. If you've got selective patient capital, that's the private equity side, then I think that's good for us. Mismatch of short-term market sentiment against long-term fundamentals, again, that's an opportunity for us. So remain positive overall, albeit that there are some challenges in the short term to work through.
I'm going to build on that and just say, I think the last 2 weeks have reminded us the macro impacts the sector has and the volatility that drives away the generalists, which I always get asked when the generalists are going to come to the sector. But building on your point, we have this big divide now between west and east of the world, where west, we're in the short-term election cycle, and I've read 17 different articles on what Trump's going to do, and we've all put our bets on, and gold sold off, and everyone's all worried. And meanwhile, you have long-term patient capital like yourselves or the Chinese or whatever, just looking and being like, well, if you're going to sell these assets, we've got a 20-year view, and we'll buy these at a discount. So I think we kind of have to marry that in a market and say, we have a new president. There's an election cycle in the US, is like every 2.5 years. There's an election cycle in Canada. Things are going to change. But 6 months ago, we all wanted copper. Now no one wants copper. So we kind of have to figure out in the long term what our long-term copper price is, and find things and value this on a 50-year basis, and as opposed to just knee-jerking in the market and selling everything off in 2 weeks and wondering what happened to your portfolio.
So I suppose keeping with what Paul was just mentioning about the election, so we do now know, at the time of writing my questions, we didn't know the outcome, but now we do. How do you think this outcome in the US election is really going to impact the markets moving forward, and the whole energy transition thematic that's been so strong in the industry so far? I don't need to hear any kind of personal feelings, but let's just see, how do you think it's actually going to play out?
I'll take this one again, but generally, if someone tells you they're going to do something and they have all the power, then just believe them that they're going to do that. So he's going to put tariffs in, and that's what the market's imputed. So there's going to be tariffs. I think the big wild card right now, and the questions I get a lot from clients, is the IRA and the whole movement on decarbonization and the green economy and what's going to happen there. And there's obviously two views. There's views that a lot of the red states in the US are benefiting massively from this clean energy push. So why would you cut your nose off to spite your face? And then there's the view that he doesn't like that stuff. So I sit on the side of, I think, IRA, and I think clean energy, and I think the cat's out of the bag on that, and that's where we have to move. But I think the jury's out on that part.
And I can add some color on that one. And I think tariff has been on mind for a lot of people since the conclusion of this US election, right? In his first term, Donald Trump did tariffs, but he did tariffs very targeted, very specific, directed tariffs. In this term, he's talking about a minimum of 10% tariff right across the board. Now, I encourage you I don't have the answer to this question. I'm a watcher, just as many of you are. But I think it's important to ask the question, will Donald Trump in his second term have the autonomy and the legislative ability to do that right across the board? And what sort of setup and conditions that we need to have for him to execute that is one fundamental question that I would encourage you to explore. The second bit is on the IRA, and I wouldn't consider or categorize IRA as a regulatory policy. It's an incentive-driven funding. I know there are people who consider IRA to be a regulatory framework, and I have a slightly different view that it's not a regulatory framework, but it is incentive-driven. And I agree with Paul that it has benefited the red states a lot more than it has the blue states. But bearing in mind that IRA is a very partisan issue, even when it went through the reconciliation process, the Republicans did not support it. Now, we want to ask the question, we may wish to ask the question, well, is IRA going to be canned? Or is it going to the bin? My straightforward answer in this current moment with the information that we are able to process is that we will see shifts in the IRA policy. There will be some modification, there will be parts of it. But the big thing that will drive that is that one of the biggest catalysts is the tax breaks. And the tax breaks are coming to an end in 2025 as part of the Tax Breaks and Jobs Act of 2017. And so the real question is, and I'll probably have Antony, Pim, and Paul comment on it as well. The real question is, does tariff plus stimulus equal inflation reduction? Is a question that we probably need to ask as we go forward. And what are your views on that one? I wonder if you have any color to add.
I think on that front, I think the challenge will be that tariffs, will have an inflationary impact. I think there will be something that will be done. I think to Paul's point, he's promised it. He'll want to see that he's done something. But Trump is also corporate America. So, whatever corporate America are telling him about tariffs, I think is probably what will carry the overall impact. And corporate America is a big beneficiary of the IRA at the moment. Most of the funding is going to the large OEMs, large manufacturers. It's not going to the smaller metals and mining projects that the people in this room probably care about a bit more. I think I looked at it, and I think less than 5% of funding has gone to critical minerals so far, or allocated, or to critical minerals. More has gone to hydrogen. More has gone to the nuclear industry. It's going to the OEMs. It's going to the larger manufacturing groups, and I think tariffs will probably impact them. I think on the flip side, I think we focus on what the US is going to do with tariffs. I think we need to put into perspective as to, is the world better prepared to deal with that now with Trump 2.0? China, I think, is better prepared. It's diversified its production base. I think it'll be impacted less as it was, targeted against China. How does he deal with that now? And that's maybe why he's going down the global route of China has diversified its manufacturing now. The world, we've seen that with the recent conference in Russia, as to the BRICS countries are working out ways to deal with an unhelpful US policy. So will the impact be as much? I think a lot of the markets that we operate in probably look to China stimulus as the biggest driver still. That remains the same, whatever I think is happening in the US.
Yeah, no, I would concur with that. And there's an element that maybe is more relevant to the IRA that we haven't necessarily discussed in this way is, like you point out, the money doesn't necessarily go to the juniors, but things like tax breaks could spur further demand that would indirectly benefit mining companies. And just like I don't like an uncertain environment and want some predictability, if I was a US citizen and I was considering buying an electric car, I would wait until I understand, what's going to happen to this 7,500 discount and how that might impact it, and whether I'll be able to buy a Chinese car at substantially less or not. And I think that's going to have more of an impact than direct money, as you point out. It doesn't necessarily flow to the mining companies. And then the whole notion of onshoring your supply chain is another one that I think is one to watch, that could have impact on projects and those that will be seen as more favorable as compared to others. All the while we're saying this, I agree with what Paul mentioned in relation to China being so important. I think October was the 1 month that more EVs were sold than ever before, and sitting in this room you wouldn't really feel that kind of euphoria, but we are really in a kind of a two-speed economy. China keeps producing and selling the EVs at record-breaking speeds, whilst we're here in an uncertainty. But make no mistake, those numbers and the volumes that China is absorbing have a big impact in and of itself to our industry as well.
So the other interesting bit is, let's assume that Trump pursues his policies vigorously as he did in his previous administration, perhaps with a little bit more extra vigor. The question on deregulation and how reducing the mining permit speeds, it's great in the short term, it's fantastic. But what happens in the long term, environmental ability? The second bit on Trump's stance on America first, a lot of priority is on the domestic manufacturing. It's great if you're operating in the US and you have interests there. What happens with the rest of the world? But the rest of the world need not necessarily follow the US on this. We've got plenty of interesting initiatives from Canada, Australia, the European Union as well. I talk about regulatory. They all say no one regulates better than the European Union. America innovates, China replicates, although that is shifting now, and the Europeans regulate. And I think part of what came at the back of when IRA was introduced was many of our European friends were deeply upset about this. We've got this new CRMA as well. It's very interesting to see 10% domestic production, 40% recycling. That is a very interesting element and picture that we must take context in. The other bit that's also very interesting is drill, baby, drill was his headline. And that's the ticket that Trump also leveraged on to get elected. So there will be sufficient interest from Trump administration to focus on some of these policies that will be directed towards fossil fuel. So what happens to the clean energy transition? Are we likely to take a hit in terms of, will this slightly derail or slow down the momentum of the requirements of materials that we need in order for us to transition into clean energy sufficiently? And America is a big producer and consumer of a number of different things. So that's another bit. That's very interesting. That'll be interesting to watch in the Trump administration 2.0. As Antony said, I'm going to borrow that Trump 2.0. I started my career in geopolitics just after Brexit, full-fledged geopolitics of energy transition, just before Trump got elected and just after Brexit. So I'm back here again talking about it ahead of Trump 2.0. So those are very interesting. And I have to agree with Pim that the benefits of IRA have been unevenly distributed. The number of top mining companies have benefited from it, but the junior miners have not seen the full benefit of the IRA. So the benefit distribution for one of the largest economies in the world is uneven when it comes to that IRA policies as well. But the most worrying trend, personally, I'd say, is the shift in terms of developing fossil fuel capabilities vis-a-vis clean energy, and how does it put any brakes or does it slow down the clean energy investment is something that we all need to pay very close attention to. I wonder, Pim, if you had any comments on that.
It's not my area of expertise, but I'll give you my personal opinion. I think there's a slight nuance. I think energy transition has positioned itself, and in my view rightly, but nonetheless positioned itself as a climate change initiative. And that's not something that I feel Trump and many of the Republicans buy into. What they do buy into, and what you could maybe leverage if you can relabel and remarket a bit is energy security. I don't think he drills for the sake of drilling. He drills for the sake, or he wants energy security. And that then happens to translate into drilling. But if renewable energy can pitch itself as energy security, it's got an equal or better chance as compared to oil and gas. And I think that's where, a challenge, but also an opportunity lies. And I still fundamentally believe in the long-term future on the back of, the sustainability of it. So I'm still with Antony on that. In the meantime, being in this industry, we all know the solution to all of this means that less money will go to exploration. So whatever uptake we will eventually get when demand slowly ticks through available supply is an even more aggressive one. But that's not really helping anyone in the room at this point in time. But it does go to show that over the longer period, these dynamics will work out in our favor. But like I said, it's not much of a comfort.
So I think that leads really well into, I suppose, the implications for the junior market and how we do bring that investment focus back in. So whether it's government, is the government stimulus helping, or do we need to look elsewhere? Is it institutional investors? Is it kind of the more generalist investors that we've been talking about, having to bring them into the market? Where do you see the investment kind of starting to come from now, or where do you think it needs to come from?
I'm going to build on something she was talking on the regulatory, because the biggest issue in the U.S. and Canada is permitting by far. Okay, so to permit a mine in the U.S. and Canada takes 15 years. So if I give you all the money to build your copper mine today, doesn't matter. And I'm watching with interest to see what he could do on permitting, but I'll give the somewhat negative, less optimistic view, which is I don't think he can do much, to be honest. And in the first term, he promised a lot in Alaska, not much happened. So we have to watch in the West, because the investors, or the people I speak to, there's always a certain set of investors that wants developed markets and is like, I don't want to take the political risk of somewhere in South America or Africa, because I don't know what's going to happen with the government. I don't know if my asset's safe. Then there's also investors who are like, well, I need a quicker capital return. So if I can build a gold mine in Ivory Coast, I can discover it, get it permitted in 18 months, get a financing package and build it in 2 years. Well, I can start getting my capital out. And if something happens in that country in 5-6 years, okay, but at least I've got my return. And a lot of the people who are bullish on Africa will tell you, yeah, there's coups and stuff happens, but the mines always run, right? The mines always run, you always get paid, and you can get your capital out quickly. So the broader issue on the investment side is, and in Canada too, so I can speak to Canada, because even, the whole process, a federal process, is 5 years now to start from beginning to finish. So you're talking to someone about trying to invest in a company, and they'll give you the feedback, well, why should I invest today? Because there's 4.5 more years of them going through a bureaucratic process where they're going to have to raise money. And I can just sit and wait. So I'd rather own this thing that going to have its permit potentially in 6 months than sit on this other project in Quebec and Ontario or wherever.
So,
Yeah, I agree with that. It's back to the predictability that I mentioned earlier. I don't think this is a matter of money. I think the money will be there, will be found for private capital, maybe even generalist, once we have the predictability. But when all of that is up in the air, that's when people really, vote with their feet and say, well, I'll stay on the sideline. And I think that's a much bigger conundrum. And if that gets solved, you'll see an influx of capital and activity in the industry.
I mean, how do you manage the risk of, say, moving outside of maybe a comfortable jurisdiction to somewhere where you can get things permitted and moved along a lot faster and getting kind of the goods out of the ground?
I'm going to say it's just diversification. So, having a generalist own a single stock or a single project is quite dangerous, right? So having an investment manager like what these guys do is the way to go, because they're looking at it, they have a diversified project set, and obviously they assess the risk and liquidity of all their investments. So it really is the best way to access the sector. I've always thought for the generalists is just to allocate to somebody who knows what they're doing.
So we have a
I think just to pick up on a couple of points. I think going back to the sort of policy and government funding, I don't think that isn't creating a momentum in the industry that is encouraging generalists to come into it and see pathway to projects being developed any quicker than they have been in the past. I think that the sums of money, I think actually in IRA and in the US, that's research and development for the oil and gas business. And I think a lot of the funding you do see is effectively a view on research and development rather than actually project development. It's not really solving a business. And the US is the only place where funding has been available. The rest of the world, there isn't government funding, proper support to get these projects, get these supply chains developed. So I think that's sort of one aspect. And some private markets, the private markets are having a big liquidity issue. I think generally, that's a product of the last 5 years, of the macro picture. High interest rates, which I think Kruthika mentioned earlier, that is high interest rates have caused an effect of one in private equity of locking up deal flow. There was a lot of liquidity that came in post-COVID. High interest rates has actually caused that liquidity to be locked up in deals. They haven't been able to exit, so money isn't coming back to investors to then reinvest in other sectors, other opportunities, new strategies. I think we can say probably in the mining, private equity world, private credit world, fundraising, a lot of the existing funds have reached the end of current fund cycles. They're out trying to raise funds. That's a slow process. It's taking 2 to 3 years probably, whereas it used to take maybe 1 to 2 years or 18 months, if it's happening at all. So I think these factors that happen in the background behind our businesses are actually what you're experiencing here. It's probably similar sort of sentiment in the public markets as well, maybe from the generalists as to where have they put their money, where they're getting the money back from, where are they going to put it next. At the moment, I don't think they've got the money to put it back into what's next at the moment. And otherwise, high interest rates is creating a lot of opportunity for people to put money into generalist areas and get a low double-digit return, low teens return, which is quite a good return in the global, big picture of your investment portfolio. If you can do credit and get a double-digit return, maybe your private equity strategies are probably only offering 14, 15% IRR over time. Why take the extra risk or lock up your capital in those strategies when there's easier returns available for your liquid money? So.
I will just add one point. I think, should there be a drop in the interest rates or a regulatory incentive, and I think that is likely to shift. But when we think about it, I look at it slightly differently. And you come from the capital markets. I'm the non-capital person sitting here. So I'll add a slightly different flavor to it. Is most countries see critical minerals mining as a national security interest. This is national security issue. So if we approach it in that way, it might be beneficial for companies to think about more deeper, meaningful strategic cooperation, regional cooperations with those individual countries where this is of top priority in terms of national security interest, because that is shifted from general mining to this is now national security. We've got departments at NATO looking at critical minerals. And NATO's business was not that several years ago. So I think maybe a slightly different approach to how companies see it and have the conversation. We might expect to see different results. Anthony, I think you have something to say.
Yeah, and just to touch on that and to agree with that, I think the one area where we are seeing more development is in the regional strategies and focuses. Clearly driven out of the Middle East is one area where you see that. Those with funds that are willing to invest on a more strategic basis, they are looking to do it to develop their own region, their own locality. So that's the one area where I think there is opportunity, and that's outside the US. It's supply chains going to the Middle East, in South America. There's a growth of the big capital allocators, the big investors who are looking, rather than looking at the markets globally, they're looking at it more regionally and more selectively in terms of how they deploy their capital. They're not giving it to necessarily the big fund managers to deploy at will. They're giving it to people with a focused strategy in focused areas. So depending on where your projects are, that's an area where I think there is a reason to be hopeful that there's an increasing or a new source of capital and a new channel of capital coming to the market.
It's quite interesting listening to you all, and the last point was quite interesting, those last 2 points. Are we watching a situation where you're looking for predictability, the whole of you are looking at the short term? Are we watching a situation where long-term capital outside the capital markets is going to be looking to take what they need for their supply chains? Obviously talking about China here to some extent, maybe the Middle East to another extent, where they have long-term capital, they don't care about the short term, they understand the long-term demands, particularly in their own industries, and they are just taking it themselves. So we've seen that where everyone here, everyone I would say, in the last 10 years have said, nickel, yes, that's going to be something which is going to be in short supply, and the advent of EVs, yes, nickel is going to be wonderful. No, it's not. China just took the Indonesian industry out, and basically all the pollution that goes with it, they don't care. They're just doing it. Now, next, potentially uranium. You're all sitting there, are you funding uranium? Are you funding uranium? Probably not. Because you cannot guarantee price. So you don't fund it. Chinese don't mind. They know what's happening with their nuclear industry. They know how much they're going to need, and they're very short. So are they just going to take Africa out? All the projects in Africa that will we get the funding? Who will do the funding? Chinese will do the funding. So is this a situation? I'd like you to have a think about that and say, yeah, maybe capital markets aren't going to be the place. We all of us sitting here want it to be the place. We want commodities to do well. We want the supply demand to be imbalanced. But no, maybe we're losing it to the longer term investors who are prepared to make that investment. Anyone to answer that?
I might just say, I think there's a distinction there between the public market and the private market. I think private, and there's a Pim's point, long-term patient capital, I think you can take a bit more of a view on that. The challenge for us is, where's the exit to? We always need to have an exit. And if you're reducing your field of exits to China, how comfortable do we feel about that? Is that a risk to us in terms of our investment strategy? I don't think it necessarily is, but it's something we're conscious of.
Yeah, I'd agree with everything you said. And the reality is China's been doing this for the last decade anyways, right? So Robert Friedland, when the market in kind of 2013, 2014 was fallow, he went to the Chinese to get his mine funded, right? So, and now you see the Canadian government trying to stop Canadian listed companies from getting funding from, the Chinese mining companies, but the cat's out of the bag. Capital is global, it competes globally, and if it sees a great opportunity and you don't see it, it's gonna gobble that up. So I don't see that abating, but it's all cyclical, right? So you had a ton of public mining funds a decade ago. There's about half the funds now, and they're there. So at some point, the pendulum has to swing back, because if the private equity guys want to realize the value and exit and they only have one buyer, the Chinese, well, that's not great for them either, because you need more than one bidder to really get a value for your asset.
Yeah, from our perspective, I'm not the capital markets. I carved out a niche. The fiduciary duty is to make money for shareholders, and the way we've gone about it is not to invest in Africa. We've chosen to back projects and bring those into production, whereby the value add of that might offset any variability in commodity price. And I said predictability. as it relates to permitting. I appreciate predictability as it pertains to commodity prices is not something I'm ever going to get. But, as an example, to pick up on nickel, we made a nickel investment in 2022. I'm not sure how much the nickel price is down. I expect materially. We're 4 times up because the business put an asset into production in that time. But it could only have done that because it wasn't a predictable environment from a permitting perspective. And it went in the space of 2 years from a development company to a revenue generating company. So that's our modus operandi. I think that can be done. There's plenty of projects out there, but it won't be every project. It's not everyone's cup of tea. It is, in our case, jurisdictionally limited for the reasons I outlined. We're a small cog in a bigger machine. I can only talk about how we work, but I don't necessarily disagree with your point as it pertains to the role that China plays. But I think outside that, there is still plenty of opportunity for other investors.
Hi, very quickly, question and comment. I would like to touch on what Paul said on the permitting, on long-term permitting, and on patient capital. My name is Trésor Chauveau. I'm originally from DRC, but I'm London-based. And I think that we really have to think about this issue of long-term capital. Why? Because of a practical example of what the gentleman said. We took over a mining property in Namibia, which belonged to Teck. It was explored by Teck and previously by Rio. And the reason why we took it is because Teck at some point just looked at the short-term game in the market and abandoned it. And today, around that area, there are 2 gold mines, 1 discovery by Osino, further exploration, another discovery not far by Wia. So, and also on the permitting. So, when you look at 15 years, people will look to deploy capital in other jurisdictions. And Africa is not a whole. You have countries such as Namibia, Botswana, you have countries like DRC where I come from, which is different. You have to look at the risk. But even now, we have a tendency to see that people who are approaching from Turkey, China, are more willing to go with us on a long term than Canada, UK, and the rest. So if we still have this perception of quick return and not looking at long-term capital, I think we will lose out to other markets, and it's going to be very difficult. But we'll get higher product with a higher premium, higher price. So we really have to look at this issue of long-term capital and permitting.
I mean, I'll just comment that I think the mining industry is quite special in terms of the level of public market companies you have compared to any other sector. So I think to that point, it's sort of, we all come from a background of being driven by what is a public market in the capital markets and how we see it, whereas it's many other sectors are not public in that respect. They're more driven by private capital at those earlier stages to get those projects into development. But
my reflection is you're absolutely spot on. If the biggest drawback is when you look at Africa as a whole rather than some parts of what Africa is made of. And I fully agree into the premise that Paul mentioned. That bus has left the station or the train has left, whichever mode of transportation you prefer to acknowledge. But what is very interesting is these are very interesting projects. 30% of the mineral resources still in the African continent. There's tremendous potential. China, the investments from China has already seen some sort of pushbacks within the African countries as well because of forward and backward integrations that most countries want to do now, and we've seen that with Indonesia, so that they want to either forward integrate or backward integrate or look at that beneficiation processing as well. This is where you want to. And also the other bit you mentioned where Western companies are not investing sufficiently in there as well is the ESG bit, which is it's impossible to, say, for example, meet the DEI requirements for a project in some of the, not many, there are some fantastic places there, but it's just really hard to sort of do that in Mali, for example. It's impossible to meet that ESG social criteria on DEI. So companies Western companies are also pushed on that regulatory bit, the ESG bit that really drives it, which is just making really things a bit more difficult. But I fully buy into the premise of your argument is absolutely sound.
So that wraps up a really great kind of opening panel for the day and for the event, and I hope you've got some good takeaways from it. And thank you to all of our panelists for joining us this morning.